Wow, builders are in trouble. One of the top economists issues a red flare warning for the US housing market. The US economy is not in good standing. The US housing market is not in good standing. If we continue reading this right here, and I'm actually going to show you some graphs, some charts, and some data points that actually resemble some 2008, 2009 the Great Recession, and could potentially be even worse. You want to hang on to this and make sure you're watching this to the end. A leading economist has issued a stark assessment of the US housing market, battling issues in both construction and sales, and warned that this could soon affect the entire US economy. I was making videos for my local Greater Salt Lake City, Utah housing market, and now I want people nationwide to have access to what's actually going on. And I'm going to share real data with you guys. And I did also actually graduate with a degree in economics, and I've almost been doing real estate for 10 years. Prior to that, I was doing stress tests and onboarding 100 million and billion dollar portfolios. Right here, you see that this economist, he said, I sent off a yellow flare on the housing market a couple of weeks ago, but I now think a red flare warning is more appropriate. And this comes from the Moody's chief economist, Mark, who wrote on Twitter, or X, formerly Twitter, and he said that the economy is just not in good standing when it comes to the housing market. Now, this is something that on my local Greater Salt Lake City housing market that I've been preaching to people and showing this data point. And this is something that's resembling what happened in 2022. And in the second half, we saw prices nationwide drop upwards of 10%. In my Greater Salt Lake City market, 15%. Well, if there's a lot of resemblances, could that be on the horizon? Well, I'm going to show you guys something here. Everybody always talks about new construction. So take a look at this graph right. Take a look at this left peak and take a look at this right peak. Now I'm going to actually explain to you what's going on. They keep saying that we have underbuilding going on. And they're saying that we don't have as much new construction as we did in 2008, 2009. Well, if we take a look at single family homes, we have maybe 20, let's even say 30% less being built right now than 2008, 2009. Well, that's still pretty high levels, don't you think? Now, multifamily, I'm sure you've seen these big apartment, if you're in any big metro across the United States, driving down the interstate, driving anywhere in your greater metro area, you've probably seen these big buildings, apartment buildings, luxury buildings just popping up everywhere or taking forever to be completed. They don't want to complete them because, well, who are they going to rent them out to? Everybody started overbuilding. That is where this graph comes into play. If you take a look, these are those apartment units. These are units 5 or more, what they're keeping track of. You see that in the 70s, we had a boom. And if you take a look here, right here at 2008, 2009, compared to the peaks that we had in 2023 and currently, we have essentially 2.5 times more multifamily being built than we did those apartment complexes in 2008, 2009. So are we actually building more homes? I mean, if somebody's renting or if somebody is buying, they still have a roof over their head. So rentals are housing just like purchasing a house for yourself. And that is a supply. So supply and demand, and it seems supply is pretty elevated right now. Now, as we continue dissecting what's going on here, remember this Moody's chief economist issued this red flare warning, and Moody's was the last major credit bureau to downgrade. So they give ratings to stocks and to countries. Moody's was the last one to downgrade the U.S. economy. S&P and Fitch, they already downgraded us, which causes the taxpayers to pay more in the debt that the U.S. government is financing. So anyway, Moody's chief economist, and right here we see the red flare warning indicates major instability and risk of a further downturn against the backdrop of slowdown in new construction activity and sales, plus a market that some experts had warned at the beginning of this year was already facing extreme difficulties. Well, that's why I started creating this nationwide YouTube channel, because I've been preaching this on my local Greater Salt Lake City area market. So you're seeing that. And if we take a look at this article here, this one is in June 30th. You see that the housing market warning issued. No one is buying new homes. Builders are just struggling. And look at this builder text that I received. This builder is offering a 5.49% fixed rate. And on top of that, $60,000 in concessions. And that can either be used to buy the rate down, can't use it all, and to make an adjustment on the price. So you're seeing that this builder, I mean, just to buy the rate down to 5.49% probably costs $15,000 depending on where the rates are. So this is essentially almost $80,000 in incentives that this builder is offering. Now, why is this important? Let me share the next article. Right here, you're seeing that the builder confidence in the US housing market fell sharply in May, marking its lowest level since November of 2023 and almost as low as December of 2022. Look at that right there. And what happened in December of 2022? Well, that's when the market essentially was bottoming out nationwide. The market peaked in my local housing market in May of 2022, and it bottomed out in January of 2023. 9 consecutive months, 15% price drops on the median price. Nationwide, it was 10%. Well, if these builders are already offering these kind of incentives, you got to ask yourself, what's to come once November and December come? I mean, if they're essentially as confident as they are toward the end of the year, when prices drop and almost as low as December 2022 when we saw severe price drops nationwide. I mean, what are these builders going to be offering? And then it's going to put downward pressure on sellers. Sellers are starting to slash prices on existing homes, and that's going to put only further downward pressure on builders. And builders, they're showing us where the market is headed, where the market needs to be. And they're in the business of selling houses. They don't care about the equity. Somebody gives free land to this builder, and the builder can all of a sudden, they were selling homes for, let's say, 500,000 or 600,000, and now they can sell them for $400,000, and their margins are the same because they got the free land. They don't care. They only care about the margins, not the equity. And the builders are showing us where it's headed. Now the fact that the builder confidence is low and that sellers are starting to cut prices, and the new sellers are coming to the market are pricing their homes at a better price point because they see the ones that are lingering, so they're actually more serious sellers. That's only going to put downward pressure on builders. Is going to put further downward pressure on sellers, especially as school year is about to start and the housing market is slowing down. Now, this was what happened with the treasury yields tumbling after that weaker than expected job data, and when we wiped out 248,000 jobs that were created less than was initially being reported. And right here, you're seeing that it was dropping off a cliff. The 30-year mortgage was just trending downward, and now it's done a U-turn. Not sure if you can see that here. And then I want to show you what's going on with the inventory. And make sure when you are using your real estate agent, wherever you're at, that you're using somebody who's going to actually give you data and information of what's going on in your local housing market. Graphs. So maybe what I'll do is I'll create some kind of course of what you can actually do to utilize the agent you're going to be working for. That way they're not fear-mongering you and keeping data away from you. I don't know how many agents are sharing things like this that I share with my clients, right? Telling them where the market is headed. And if you take a look, you're seeing that my inventory in my local housing market, this blue purple line at the top, is much more elevated than the years past. And it's resembling what happened in that second half of 2021 and 2022 where inventory was skyrocketing. Well, same resemblance right here. If you take a look, you're seeing this inventory was exploding in 2022 in the second half. And that's where you saw that downward pressure on prices nationwide. Well, we're seeing that the inventory this year is higher than in the years past. And this is holding true in a lot of markets around the United States and on the nationwide level. So make sure you're following what's going on here. But you're seeing that the inventory in my market here is starting to plateau. And this is actually happening a little bit nationwide. And the reason that is happening is sellers are starting to take their houses off the market at an extremely fast pace. And this actually isn't all bad news for the buyers. And I'll explain this in the next video. So make sure to subscribe, make sure to hit that like button, push this video in front of more people because they're not gonna be able to find this information anywhere else. And right here, if you take a look, for example, this is my local housing market. Number of listings being entered is much higher. Well, if it's continuing to be elevated, shouldn't the inventory keep elevating itself? I mean, look at this. In April, we had almost 900 more units hit the market than in 2024. And if we take a look at our solds, they were essentially the same all year long, except here in May and June, we saw a slight spike, but that was only 100 units and 200 units. So essentially, let's even say that's another 100 spike here in July. That's only 400 units more. But if you take a look, you see that I mean, we had over 400 units more just in July being posted. Another 400 here, another, 400 here, another 900 here, another almost 1,000 here, whatever it is. So That's because sellers are taking their house off the market at an extremely fast pace. And I'll cover that in the next video. So again, subscribe, smash that like button, and we're going to do a quick recap here. I'm going to show you guys. So you're seeing this inventory is elevated, and it's elevated nationwide as well on a nationwide level. You're seeing much more inventory as far as these big apartment complexes. Look how much more of these apartment complexes are hitting the market right now compared to 2008, 2009. So don't let them lie to you that the inventory levels are not there, that the new construction isn't there. And economists issue a red flare warning for the US housing market. We're seeing that this could soon affect the entire economy. We're seeing right here a red flare warning indicating what experts were saying was a bad year to start off with right here. You're seeing that we're essentially in the spring seeing 13% drop in sales month over month and 6% year over year. You're seeing that new construction, I mean, no one is buying new homes. I mean, of course, somebody is buying them, but essentially these builders are really desperate. I mean, they're having to do things like this already in the spring selling season and in the summer, offering these crazy incentives. And the sales are just not where they need to be for home builders. And they're going to keep dropping those prices. And we're seeing that the builder confidence is essentially as low as it is in the second half of the year. And that's what resembles price cuts and better price buying opportunities for buyers. So you're seeing all of that. Again, make sure to subscribe, make sure to hit that like button,